Hello, good morning, everyone. Welcome to all of you for today's session. Students, just let me know whether you people can hear me well. Can you hear me?
Yes.
Right. So let me open the Excel sheet. In the last class, students, we have discussed IRR, MIRR, NPV, duration. These topics we discussed in the last class. So today we are starting with the adjustments of NPV, then annuity and perpetuity. We will be talking about now. So students, here we are. So students, NPV and adjustment. So basically, when we talk about the NPV performer, the cash flows performer, in that performer, the first adjustment is inflation. Adjustment of inflation. What is inflation? Increase in general price level. Increase in prices of the product. That is called inflation. And inflation can be of two types. One is called specific inflation, and the other is called general inflation. Two types of inflations there are. Now, general inflation is the basically, average inflation rate in the economy. And specific inflation is you can't see my screen? Okay, just a minute. Just a minute. Now, is it visible? Is it visible? Good. Now, thank you. Thank you. Thank you. So, specific inflation. Specific inflation is the basically specific price increase in a product. For example, product or service. For example, we say selling price increased by 10%. Wheat price, rice price, this specific increase is called specific inflation, right? Specific inflation. The general inflation is basically average inflation increase in the economy. Now, students, so on the NPV performer adjustment, the first adjustment is on the discount rate, cost of capital. Impact of inflation on the cost of capital. Yes. Students, on the cost of capital, the impact is like this. You know that there can be real cost of capital, there can be nominal or money cost of capital. Yes, real cost of capital is that cost in which inflation, we can say without inflation effect, that is called real cost of capital without effect of inflation. So nominal cost of capital, which includes the effect of inflation. Now, students, there is a Fisher's formula. Fisher's formula, which tells the relationship between the both. What is that? That is 1 plus money cost of capital is equal to 1 plus real cost of capital into 1 plus general inflation. So if you have given a real cost of capital, you can calculate money cost of capital using this formula, very easily, or vice versa. You can convert from one type of to the other. You can do that. Next. Let us proceed further. The next is NPV adjustment and impact on cash flows. Impact on cash flows. Impact on cash flows. What is the impact? What will be the impact on cash flows? So then, similarly, there are the real cash flows, which are also called cash flows in current terms. Price term, or in today's prices. Then is the nominal cash flows, which are also called money cash flows. They are inflated cash flows. Nominal cash flows are inflated cash flows with inflation. Now, the next point is student, why we are discussing inflation? So basically, there are approaches to calculate NPV. Basically, approaches to calculate NPV. There are two approaches. One is called nominal approach. The other is called real approach. Nominal approach is that you convert all cash flows into money cash flows or nominal cash flows. Means inflate all cash flows using specific inflation. And then discount net money cash flows using money cost of capital. Using money cost of capital. Now, the next is real approach. Real approach. So students, you need not inflate anything. Discount real cash, net cash flows. Using real cost of capital. Real cost of capital. Next. Let us proceed further. The next point is this is the basically adjustment of inflation in the NPV, right? Now, adjustment of taxation. Student, this is clear up till now? Tell me. Any question? Is it clear to everyone? Now, taxation adjustment. Adjustment of taxation. Now, student, taxation adjustment in the NPV pro forma is done in two basically sides. The one is, again, impact on cost of capital. First of all, impact on cost of capital. Always use post-tax cost of capital to discount or to calculate NPV, unless stated otherwise. Our preference will be to calculate post NPV using post-tax cost of capital. Next. Let us proceed further. For example, post-tax cost of capital is equal to pre-tax cost of capital into 1 minus tax rate. Very easy to calculate. If pre-tax rate is given, for example, that is equal to 12%. Tax rate is 25%. So post-tax cost of capital can be calculated very easily. Pre-tax rate into 1 minus tax rate. Yes. Now, next. Now, impact on cash flows. So impact on cash flows is basically, that is of two types, impact. One is impact on, the first thing is tax on taxable cash flows. And the second is tax saving on capital allowance. Tax payment. Tax saving on capital allowance. Now, next. You see here, we calculate sales minus costs, variable cost. Yes. Minus fixed cost. Minus fixed cost. Now, then students, here, just see here. Tax saving on capital allowance. We need to calculate annual capital allowance on the assets. Let me take the assumed figure. It is 10,000. It is 4,000. It is 2,000, for example. Right? Now, so tax saving on capital allowance, we need to calculate every year. For example, we need for that purpose, we need capital allowance. For example, the asset value, our investment value is 20,000. Life is 4 years, 5 years. Yes. And residual value, that will be 4,000. Reducing balance method is the capital allowance 25%. Now, you see here, we need to calculate annual capital allowance throughout the life. You see here. Here 1, 2, 3, and 4. This is the written down value of asset. This is the capital allowance. The written down value and capital allowance. So written down value is 20,000. Capital allowance. This into 25%, reducing balance basis. This minus this, written down value. Yes. Then is again capital allowance. This minus this. This into 25%. So this minus this. And the final year, scrap value will be deducted from it. Scrap value will be deducted from it. Student, this calculation, I will repeat, it is 25% of it. Then written down value. This minus capital allowance charge, again 25%. It will continue until the final year arrives. In the final year, the capital allowance will be the book value minus residual value. Book value minus residual value. Now, next. So students, for example, it is year 1. So I'm doing for working 1. So capital allowance will also be deducted. Capital allowance will also be, what happens? Yes, deducted. Why? For the sake of charging tax saving. That is equal to minus year 1. For the sake of charging only what? Tax saving. Let me assume it is 20,000. Okay. Now you see here, taxable profits. Taxable profits. Sum from here to here. Then is tax payment. Yes. Tax payment. That is equal to this into what is the tax rate? For example, that is 30%. Negative. Tax payment. So for example, tax rate is 30%. Right now. So tax payment will be there. Now here is the post-tax profits. What is that? This plus this. Now add back capital allowance. What we deducted here, we will add back. Same we will add back. Students, why we deducted this 5,000 here? Just for the sake of calculation of tax payment. I repeat, why we deducted this capital allowance there? Just for the sake of calculation of tax payment here. Otherwise, we would not have done it. Otherwise, we would not have done it. Now, so we have deducted it. We paid tax because taxable profit reduced because of it. We paid tax, then we added it back. So tax saved because of it. And second tax payment as well. This adjustment is clear to you people. Tell me, is it clear?
So I have a question for the written down value. Why don't you go up to year 5 when in fact you say the life is 5 years?
Oh, sorry, my mistake. 4 years it is. Okay, you are right. You are right. Okay, next. Is there any question? Anyone else? All right. Now, silence. Silence is means I should consider that it's okay. It's good. Okay. So we will do another example. We will do another example. Students, first of all, initial investment is this is initial investment. Scrap value is yes, and capital allowance rate that is 30%, reducing balance basis. Now, life is 5 years. I want every one of you open your Excel sheet and calculate capital allowance for yearly capital allowance, annual capital allowance. Yes, be quick. Annual capital allowance. Be quick, everyone. Yes, calculate this capital allowance for 5 years. If you have done it, do let me know. Then I will be calculating it with you people here. Then you can match your answers. Okay, so you people have done it, I think, for the, you just see here. First year, first of all, year 1, 2, 3, 4, and 5. For 5 years, you need to calculate. So written down value, that is equal to 192,000. So 30%. This into 30%. This minus this. Yes. So in the final year, that is this minus this. So yes, I'm sorry. So this is the way you will calculate annual capital allowance, this one. So for example, let me calculate year 1 cash flows. So sales, for example, that is 250,000 into, assume figure I'm taking 1.1 into 1.1. I'm taking all assumed figures just to explain it. Here, variable cost, for example, it is minus this into 25%. Yes, fixed cost. For example, that is 45,000. I'm taking the same all the year, for example. And now capital allowance will be deducted. Minus this. Here will be the adjustment. You see here, capital allowance. All right. So the next is taxable profits. from here to here. So tax is, for example, 20% tax rate. For example, tax rate is 20%. In arrears, you see here what is going to happen now. So tax minus this into 20%. So for year one, tax will be paid in year two. You see here and here. For year five, tax will be paid in year six. Add back capital allowance. This one, which we deducted, now we will add back. Yes. So actually, it started from here. Now we can calculate net cash flows. Net cash flows are here. Any adjustment you want me to re-explain, do let me know, please.
So just I wanted to confirm something with you for the capital allowance. So in your final year, you use the book value at the beginning of the year, and you would just subtract your scrap value. You won't allow for capital allowance in that year.
No, I didn't understand your question. In the final year, what I have done? Book value?
So you've book value at the beginning. Yeah. So you don't allow for the...
Because you know that. You can do that even. Finally, you get this. Because this is the final year of the asset. After this, it will be scrapped. In our account, it stands at this price. But in the market price is this. So whatever the difference will be, that is loss. That is capital allowance. That should be charged.
Okay.
Okay, right? Now.
Yes.
So here we are. So this is the net cash flow, if we want it. Next. So adjustment of taxation is also done. Now, the next is, what is the next? Yes, working capital. Working capital adjustment. Very easy. In different ways, they ask working capital adjustment. For example, they say, case example 1. They say working capital initially will be required will be 200,000, and then the requirements will grow with rate of inflation of 8%. Simple. For example, life of project is that is equal to 4 years. Okay, make it 5 years. More explanatory it will be. So you see here. Okay, come here. So working capital, year 0. Working capital level Initially, it will be 200,000, right? Then they say it will grow with 8% annually. 8%. Right? Now, so students, I suggest to you calculate it for, if the life is for 5 years, calculate for 4 years only. Because in the final year, it will be outflow and then inflow. That will be net off. Whatever will be outflow, that will be same in the inflow. So calculate for 4 years. So incremental working capital. Negative this. This is outflow initially. Then what is the outflow? We needed this. Already have this. So additional outflow will be this. Already 200,000 is the outflow. We needed 216. So difference will be the outflow. So simple is that. We need this. Already this now. So difference is the outflow. Negative. We needed this. Already this. And so on. So now in the final year, up till now, this is the total outflow of working capital. And this will be recovered inflow. Incremental working capital. Yes. Here it is. I will explain it once again. What we did, we inflated working capital with the rate of inflation. 5 years is the life of the project, but we inflated for 4 years. Why for 4 years? Because in the final year, 5 years, there will be outflow and inflow. Same outflow and same inflow, net off, zero impact. So then we calculated incremental working capital for each year. Incremental. And what was the total outflow in the year 4? Total. That will become inflow in the fund. So this is the cash flow adjustment, which will go here. Net cash flow. Now I will add, for example, working capital adjustment here. Now, so before working capital. Now working capital adjustment will come here because here 0 is also there. Let me move it here. Here 0. So working capital adjustments. Here comes. Any point, in the Excel, sometimes it seems that I'm working a bit fast. And, I'm trying to slow down my pace and try to explain each point 2-3 times. Wherever you feel like I have gone a bit quicker, don't hesitate to give a buzz in the chat box and ask me to explain again. Don't hesitate at all. Is it clear, students? Tell me. Working capital adjustment is clear? I need response, please. If there is problem, tell me, please, so that I can proceed confidently that you have understood this concept. Tell me, please. Is it clear? Okay, right. Let us proceed further. The next point is, sometime, another example 2. Sometimes they ask you that working capital of, for example, 10% of sales will be required at start of the year, each year. Then this is another way they ask you. So what I'll be doing, I'll be simply copying this sales value from here. So sales is here, example. So working capital we are going to calculate. -10% of sales. %10 of sales. This is 10% of this. 10%, 10%, 10%. Now incremental working capital. Why -%? I'm sorry, this negative should not be there. Yes. Incremental working capital. Now here will be the negative this outflow equal to negative. This level is required. This is already there. Simple is that. And finally, this is now the final total outflow. The same will be the inflow. The same will be the inflow. The same will be the inflow. Now, next. So students, it is done. It is done. So NPV and adjustments are done. NPV and adjustments are done. Now we will proceed with the next point of agenda. Adjustments are done. It is done. So annuity and perpetuity, right? We will be doing it today. What is 84? What is 84? Priyanka, what is 84?
Sorry, it's a typing mistake.
Okay, right, no worries. So we will proceed towards annuity first. Then we will come to the perpetuity. Students, what is annuity and what is perpetuity? Very easy concept. It is a revision. But remember, you should be well versed with this concept of annuity perpetuity for AFM paper. Annuity. Annuity is a series of cash flows with, number one, constant amount, constant interval, 3, for limited periods, limited or known periods, we can say. Same cash flow, same interval for limited or known period of time. Means we know for 10 years, for 20 years, you will be getting 10,000 every year, 10 million every year for 5 years, for 7 years, for 10 years. So present value of annuity. How it is calculated? Annual cash flow into annuity factor into annuity factor. Now, so students, for example, year 1, 2, 3, 4. Okay, you'll be getting 25,000 every year. Students, tell me one thing. Basically, annuity perpetuity is a topic from F2. You want me to explain it in detail here? Tell me frankly. I am on it. I am just concerned you might not be getting bored when I'm explaining it. Tell me, should I re-explain it? Should I explain it in detail? Annuity perpetuity? Why I don't get response from you people? This is unfair, you know. When I'm asking a question, you should speak. Annuity and perpetuity. Only 2% responded. Should I explain it detail or it is clear to you people? Annuity perpetuity. Okay, right. Right. Okay. So then only one thing I want, that is perpetuity with growth. With growth. There are some people who are not speaking, you know, and I am concerned about them. Sharon is not speaking. Zakia is not telling a single word. You know, I'm concerned that they are silent and they might be thinking Mr. Hamzah should explain it. That's why I am concerned. Now, so perpetuity with growth is basically the case where cash flows grow with a constant rate for the foreseeable future. For the foreseeable future. Okay, right. For the foreseeable future. For example, so there is a formula how to calculate present value. CF1 cash flow in the first year of perpetuity divided by discount rate R minus growth rate, perpetuity with growth, its present value. Where CF1 is not given, CF1 is equal to CF naught into 1 minus 1 plus G, where CF1 is equal to cash flow in the first year of perpetuity. CF naught is equal to cash flow before start of perpetuity. So this you should be clear about. Now, so students, the next topic is risk and uncertainty in investment appraisal, sensitivity analysis, simulation model. So I hope I will cover these two. Yes, and then most probably these two as well today itself, most probably. Just give me a 5 minutes break. Just give me a 5 minutes break. I'll be back and then I'll continue with risk and uncertainty in investment appraisal. So see you. All right, students, now we are back and we will be talking about risk and uncertainty in investment period. Student, whatever the cash flows, we are, whenever we are predicting a project, we are evaluating it today itself. So, but we fear that there are uncertainties attached with that. So uncertainties are attached that whether these cash flows will be received, and there are certain risks attached with that. So now we have to consider that means that risk and uncertainty in the investment appraisal. Now, so the first of all is the sensitivity analysis, which talk about the same consideration of means uncertainty, then simulation model, and then is the expected values. Then okay, right. So students, so considering yes uncertainty in the investment appraisal. So the sensitivity analysis is used. Students, for any project, we know that if NPV of project is positive, we say accept the project. You see that? And if NPV is negative, we say reject the project. So the point is, the project will be at risk. The project will be at risk of converting its NPV from positive to negative. Today, we are predicting that NPV is positive. But in fact, there might be certain factors, if they change negatively, adversely, the NPV may become zero. NPV may become zero. There might be certain, factors. If they change negatively, NPV of the project may become zero. So sensitivity analysis, actually, it analyzes the impact of a change in a variable on NPV of project. In other words, it assesses the impact of a variable on NPV of projects. Variable change. Yes. In other words, let me change the word. Yes. It assesses that how much a variable should change to make NPV of project zero or negative. Then how much? So sensitivity analysis, it talks about it. So let us proceed further. How? So sensitivity is equal to NPV of the project divided by present value of post-tax variable. Post-tax variable. Yes. Present value of post-tax variable. For example, we say that, very easy, that we say that, okay, selling price. Sensitivity of NPV towards selling price. Selling price or sales. So we can easily calculate. So sales of company, for example, calculate annual sales of company. Do post-tax sales. How? 1 minus T. By multiplying each year sale with 1 minus tax rate, post-tax. And then calculate present value of the post-tax sales. We already have NPV. NPV divided by post-tax sales. It will be done. Same is the case with the variable cost. Fixed cost. Same has to be done. Same has to be done. It's quite easy. Now, sales volume. We need to calculate contribution. Yes, annual contribution. How that is calculated? Sales minus variable cost every year. Then post-tax annual contribution. Then present value of post-tax annual contribution. This is then sensitivity towards sales volume. Sensitivity towards sales volume. Now, next. Students, the next is sensitivity towards cost of capital. Now, sensitivity towards cost of capital. For example, with example we will learn. There is a project with the following cash flows. Year 0, net cash flows. For example, these are the net cash flows. And cost of capital of company is, that is, for example, 10%. What we need to calculate sensitivity of NPV towards cost of capital. Yes. So we need to calculate IRR for this purpose. IRR of the project. IRR of the project. Yes. Now, IRR is the actual return of the project. Cost of capital is the cost of funds. So what is the difference? You see here, sensitivity is equal to IRR minus cost of capital divided by cost of capital. How much cost of capital should increase to make NPV zero? At IRR, cost of capital is zero. So at IRR, NPV is zero. Sorry, I repeat. How much cost of capital should increase to make NPV zero? We know that at IRR rate, NPV is zero if it is discounted. Now, what happened? Yes. So cost of capital should increase by 211%. So cost of capital should increase by 211% to make NPV zero for this project. Yes. So basically, which formula we use? We calculated this. How we calculated? We calculated using this formula. IRR of the project minus cost of capital divided by cost of capital. We use this and calculated this. Is it clear to everyone? Tell me, please.
Yes.
Right. Look how easy question. Now, next. Yes, the last is sensitivity towards project's life. Yes, it happens as well. Sensitivity towards project's life. I will take the same cash flows which I used above. How it is calculated? Through, first of all, calculate discounted payback of the project. The cost of capital is, for example, 10%. So discounted payback, this is step one. So present value at the rate of 10%. Okay, be quick, calculate everyone. We have learned it in the last class. Give me discounted payback of this project. Give me answer, please. Discounted payback. It should not have taken this much time. It is dangerous. It is not good. Not a single answer. How to calculate discounted payback? First of all, present value. Of cash flows. Now cumulative cash flow. It is not that tough. The time you have taken. So 2 year complete. 1355 divided by 2096. If you have not prepared last lecture, do prepare. 2.6 is the answer. Year. 2.6 year. It will be dangerous for you in AFM if you do not prepare a lecture before next class. So, sensitivity. Project life is 4. Payback is 2.6. Product life is 4. Yes. If project life is decreased by 35%, NPV will become 0. NPV will become 0. Now, is it clear? Is it clear? You know, in the discounted payback, only initial investment is recovered. Only initial investment. So that's why if your total life becomes this, you will recover only initial investments. So how much total life should fall? So how I calculated total life? Project life minus discounted payback divided by product life. This divided by project life. Now, next. The next point is, if it is clear, we can proceed further.
Yes.
Right. So students, sensitivity analysis is done. Sensitivity analysis, its advantages and disadvantages. Let me open it from the notes. Yes. Yes, the first 2 points are quite easy. It indicates how critical are some of the forecasts. Which variable the most critical, where a small change can make NPV zero. So it will help us to identify those variables and hence manage those variables, monitor those variables. It will help us that. Sensitivity analysis. Disadvantages. Yes, it is considering each variable in isolation, one by one. In practice, variables are interdependent. They should be considered. For example, it is considering only variable cost. It is considering individually fixed cost, sales, not considering impact of all, together. No, it is not considering. Second thing, yes, it is saying if cost of capital is increased by this, now what are the chances of increase? It is not talking about that. If product life falls by this, what are the chances of decrease? This decrease? No answer. So it does not look at the probability of change. It is not an optimizing technique. Means that now what to do with it? How to stop it falling by this? How to stop it by increasing by this? This is silent. It is not giving any solution to us. We have to find solution ourselves using some other ways. So sensitivity analysis only tells this is critical variable. Now do whatever you can do. It is not itself telling any solution. Yes. Now, and yes, sometimes critical factors, change in price, change in cost, maybe due to inflation, we cannot do anything. Exchange rate, we cannot do anything. Possibility is there. So now, the sensitivity analysis is done. Students, after sensitivity analysis, there was a major critique, this one, that it considered each variable one by one. It is not considering them in relation to each other. And it is not assessing the impact. So there came the simulation model. So consider the so many Monte Carlo simulation model. Many variables at the same time. Its calculation is not part of our syllabus. It produces a distribution of possible outcome. Distribution, normal distribution, standard deviation, and calculate. So what they do? Specify major variables. What are the variables? Market size, selling price, growth share, investment. And the relationship between the variables to calculate NPV. For example, sale revenue is equal to market size into market share into selling price. Net cash flows. This relationship you define in the formula. Just like in the Excel we do. Simulate. And computerized model will generate a range of NPVs across all probability levels. Simulate and computerized model will generate. So we have not to calculate, we just only know the steps, the meaning, and merit. It includes all possible outcomes, wide application, yeah, demerit. It is complex model, time and cost is involved. Yes, probability distribution, statistic of NPVs, that statistical knowledge, technical, and data input, sales, variable cost, market share. If that data first you have to acquire, if data is not accurate, output will not be accurate. Accuracy of the result, output means written result, depend upon accuracy of data input. Yes. Now, students, this is the simulation model we have done. The next topics are, two more topics we'll be doing today, expected value and value at risk. But before that, again, I will be taking a short break once again, but yes, 8 minutes break. This is my way. I normally take after 1 hour, one break, normally, or at the end of a major topic. So the students can have some refresh mind. Okay, right. So you can have, refresh mind and before starting the next topic. So see you in 8 minutes. Yes, please. Next. The next topic is expected values, which is basically probability analysis. Students, expected value is basically that when we have different possible outcomes, then we say there is, for example, let us learn it by example. For example, selling price expectation. That is $10, $15, and $6. Three possibilities are there. Yes, selling price. Three possibilities. And probability of each is given. Probability of each is given. For example, it is 20%, 35%, 25%, and 55%. What is the, so three possibilities are there. So we will calculate Px, P for probability, X for amount. So Px, this into this, Px. Here we go. And here is sum of all. So this will be the, sorry, here. Sum of all. This is the expected value, expected selling price. It is basically average out. We multiplied each amount with the relevant probability and then calculated the average. So expected selling price. Here it is. So if we come to the notes, so it is calculated like that. You see here, probability example, selling price, similar example is given here. Okay, and then it is calculated expected selling price. Joint probability. Yes, joint probability. Now, what is it? When more than one probabilities are involved. More than one probabilities are involved. So you see here, there are the 3-year sales volume given. Just a minute, please. 20 and okay, right. Okay, let me draft it here myself in the Excel sheet. For example, cash flows are given that there is selling price. Selling price. Expected selling price is $60, $45, and $30. Probability. Probability. Probability is that 40%, 30%, and 30%. And this case has overall chance of Yes. For example, it is the market will be in good condition with a chance of 75%. And market will be in the worst position. Worst position. Then selling price will be $10, $20, and $25 with the probability of 35%, 10%, and 55%. You will see this explanation. This will be wonderful and interesting as well. Now, next, you see here, they say in good condition, chances of 75%. So what is the condition of worst position? What is the probability? Remaining 25%. Either it will be in good condition or it will be in the worst position. So two probabilities are attached with it. There are two ways to solve it. The one way is you just calculate Px, simple, this into this. And you calculate sum of this. Right? The second way is, and then this with this, in the worst condition, is equal to sum. Yes. Now, so selling price, expected selling price, that is equal to 75% chances are that it will be how much? This. And 25% chances are that it will be this. Expected selling price is there. There is this simple way. Now, next. The next point is, so this is the expected selling price. There is another way to do this. There is another way to do this. Let me copy paste it first. We can calculate joint probability over there. Another way to do this. Yes. So 75%, probability 1, probability 2, that is 75%. 75%, right? So joint probability This into this. Yes. It is 25%. So joint probability. This into this. Yes. So expected value, JP into X. You see here. Now joint probability into this. The other way. Now sum. Same you see. This and this. The other way. Joint probability. Let us proceed further. Is it clear? Expected value is clear? Tell me. Tell me, please. Good. Now, so advantages. It is weighted average of the value, or different outcomes are considered. So it recognizes the risk and decision based on different probabilities. Yes, single figure answer. One single answer. And the same single answer is limitation too. First of all, different possible probabilities. It is very difficult to calculate. Probability calculation is difficult. And you see here one drawback. We calculated expected value 39. In actually, either this will be the price, this or this or this. Out of these 6 will be the actually price. This will be not be the price. You got the point? So expected outcome will never be achieved. Expected value is not. Yes. Yes, it can only be achieved if the company has to launch same project again and again, many times. Then average out of all projects, same project, if it is being launched many times, sometime you get this, sometime you get this, sometime you get this, and then finally average out, you get this. Actual expected value can be achieved only if a project is launched many times, again and again. It can be achieved only. Now, student, if it is not clear, do let me know. I have explained it, right? So unless same decision have to be made many times, the average will not be achieved. So that's why it's not a valid way. Because project may not be repeated again and again. It may have to done only once. Range of possible outcome. It is giving only one answer. In practice, all these outcome range individualized basis. We should calculate NPV on this basis, then this basis, then this basis, then NPV this basis. Range of NPV should have been calculated in practice. One outcome is not suitable. Student, any point you want me to re-explain out of these 4 points? They're very important points. Yes. Tell me, please. Any point you want me to re-explain? Is it clear? Right. Now, so students, expected value is done. Now the next topic is project value at risk. Now listen, please. We have covered a major chunk in the syllabus. Project value at risk, I will cover now, and then value at risk, not R. And in the next class, I am telling you in advance, we need to do 2 past exam questions. So prepare all this very well. Prepare all this very well before next class. So value at risk. Value at risk. What is value at risk? Basically, we want to identify what is the maximum amount a project may lose at certain confidence level, or let me open it with you people. Sorry. Yes. And minimum amount. The second is the same meaning. Or what is the minimum amount it will lose, a project will lose at a certain probability level. Now, you need to understand the difference between them both. 95% confidence level means %5 probability. 99% confidence level means one percent probability. Probability. 1% probability. Now, next. So you see here, value at risk. The formula is given here. I will not type it here. Yes, for example, value at risk is 1,000 at 5% probability level. Or it is 100,000 at 95% confidence level. How to explain it? That there is 5% chance that a loss of project will exceed this. Or 95% sure that it will not exceed this. The formula is here. Value at risk, K, standard deviation into N number of years. The value of K you need to memorize. At 5%, it is this. You need to memorize this number. I'm telling you in advance. 1% level, it is 2.33. So, the annual cash flow from a project are expected to be the standard deviation of 10,000. Product 10-year life. Standard deviation here. What is the value at risk? So you see here, so value at risk for 1 year, a year, K at 5%, K value of K. Then standard deviation, number of 1 under root. Entire product life, 10 year, it is basically 10 square root. You can correct it if you have printed it out. It is 10 square root. 10-year life, square root like this. This is the maximum amount by which the value of project will fall at a confidence level of this. Yes, the maximum amount or minimum amount at 5% probability level. Now, so one more example we will do. For example, standard deviation of the project cash flows are 120,000. Project life is 5 years and calculate value at risk at 99% confidence level for 1 year, for 3 years, for project life. 3 cases. So K, value of K at 1% probability. Probability, yes. So that is value of K. That is 2.33. 2.33. Now, for 1 year, K into standard deviation into, for 1 year, 1 raised to power 0.5 square root. Here it is. You can see the calculation. N is number of years. Now, the next point is K into standard deviation into 3 raised to power 0.5. Here is the answer. For life, K into standard deviation into 5 raised to power 0.5. No explanation. You can explain it in two ways, and both are valid. At 95%, sorry, at 99%, at 99% confidence level, because they asked for 99% confidence level. So we will explain like this. The project will lose 279,600 over 1 year. And this over 3 years. This over maximum. Or at 5, if you have to print the probability, at 5% probability or 1% probability, at 1% probability, the project will lose its value over 1 year by 279,600 minimum. Yes. Is it clear to everyone? Tell me. Is that clear? All right. So students, your WhatsApp group for class will be created in this week. And then, of course, I'll be sharing all these documents over there as well. But I'm sending you this document now here so that you can revise it well on a regular basis. Okay? So, and I'm suggesting you that please do revise this lecture, prepare it well before next class. I have sent you in the chat box here. Download, please, everyone. Download this document. I've sent it. Now, so student, that's it for today. I'm telling you in advance, in the next class is very important. Capital rationing will be the topic. I think it will take 30 minutes in the next class. I don't want to do it today because we have already done a lot of work today itself. So in the next class, we will be proceeding towards this and the practice, and then we will start with the WAC. And we are going good, speed. So of the syllabus. So thank you for joining me, right? See you next week. Goodbye. Goodbye. Thank you.